Hello there, I'm your host Leelaa Rao, welcoming you to your fortnightly program Invest Wisely, your ultimate gateway to safe and intelligent investing. Coming up in this session, international investing, the safest way to do this. Are you aware of the fact that you can invest globally by trading locally? Let's look at the best ways to diversify globally without worrying about transferring funds internationally or be anxious about international tax laws. Following that, emerging markets. Are they right for you, and how much, and how to add them in your portfolio? When the US and the other developed markets are going south, some emerging markets are growing at a faster pace. How can you cash on their success without sacrificing the safety of your hard-earned assets? We will explore the best ways. And finally, in question time, we will discuss some interesting emails by investors. International investing. What are the safest way to do this? Before we start off with the first topic of the day, I wish to introduce a term called correlation, which is very important with respect to effective portfolio building and also diversification. Let's assume we have two stocks, A and B. When the stock A moves in the same direction as stock B, they are said to be positively correlated. When stock A moves in the opposite direction to stock B, they are said to be negatively correlated. This is true of the various sectors in the market and also of the stock markets in the world as well. This depends upon the strength of their individual economies, currencies, political stability, and various other factors. Different markets tend to move in different directions at one point in time. But let me tell you one thing. Of course, in practice, there are no two absolutely negatively correlated securities or markets. If you are able to combine a bunch of well-researched securities from different markets that are not positively correlated, you can limit the anguish of losing a big chunk of your precious portfolio. Now the question is, why invest internationally? Well, the answer to this is simple: diversification. And this word has become extremely important and rather essentially, especially during tough times in the markets. Do you know that the US market only represents half of the value of the whole universe of the global markets? By limiting yourself to the US market, you are depriving your portfolio of the benefits of growth and value in the other half of the global financial markets. And also, when your entire portfolio contains nothing but US equities, you tend to subject yourself to the risk of a single country or geographic region. Another important benefit of diversifying internationally is the hedge against US dollar depreciation or possible devaluation. This is because when you buy a foreign security, your capital appreciation as well as your income is in a different currency other than the US dollar. Keeping these aspects in mind, the best proportion for a healthy portfolio would be 50% in the US markets and the other 50% in the rest of the world. Well, depending upon the economic situation, I would even increase global exposure up to 70%. This also depends on the individual circumstances and profile of the investor. Now, how do we gain this international exposure in our portfolios? There are several ways to go about adding international elements in your portfolio, like investing in international ETFs. International ETFs are exchange-traded funds focusing in one economy or region. You can buy for your investment portfolio that track most of the major foreign indices, and they allow investors to obtain a return based on a specific foreign market without having too great of an exposure directly into the foreign economy or currency. You can add ETFs to your portfolio along with other domestic stocks and bonds. The other is mutual funds. Mutual funds are totally dedicated to a few countries or regions. There are several star-rated mutual funds that invest in international companies, both in their stocks and bonds. There are global funds or world funds that invest in stocks and bonds of almost all the countries. There are funds that concentrate in only one country or group of countries. There are funds focusing on a particular geographic region like Europe, Asia, Africa, etc. I have seen in my practice lots of clients being confused between an exchange-traded fund and a mutual fund. Briefly, here is the difference between the two. ETFs or exchange traded funds track an index and hence are passively managed, whereas mutual funds are a combination of stocks and sometimes even bonds and are mostly actively managed, except for index funds which are passively managed. The different modes of investing I discussed with you so far do not provide you with the opportunity of choosing individual international securities. But if you wish to build a portfolio of hand-picked, well-researched global equities by trading them like domestic equities, ADRs or American Depository Receipts provide you the best option. Now, what are these ADRs? ADRs signify ownership of shares in foreign companies. ADRs are created when a foreign company lists its already publicly traded securities on the US Stock Exchange, like the New York Stock Exchange or the NASDAQ. Foreign companies with ADRs issue financial reports that generally conform to US accounting conventions or the GAAP and rules of the SEC. So ADRs are a lot more transparent than directly investing in a company that is only trading on a foreign stock exchange. Since ADRs are traded on the US Stock Exchange, they can be bought and sold with ease like domestic stocks. Let me share with you this interesting piece of information. ADRs are not a creation of the recent times, but were crafted or created by JP Morgan in 1927. Before these innovative financial instruments came into being, investors had to open accounts in foreign brokerages and exchange currencies in order to purchase shares in foreign companies. Let's see the benefits of using ADRs in your portfolio. Participation in growth of a foreign economy. ADRs prove to be a brilliant means of participating and profiting in fast-growing economies. Several international markets, especially emerging markets, have higher growth rates than the United States or the UK. List American stocks in your portfolio may be going nowhere or even declining. Adding a few well-defined ADRs in growing economies has the potential to provide you with solid returns during slumps in the US market, benefiting from US dollar depreciation against a foreign currency. It is known fact among investment managers that several foreign companies have a much higher dividend yield than US companies in the same industry. Investors can realize through ADR investing favorable currency conversions for dividends. Say, for example, you own shares of an ADR of a UK company and the sterling is trading at a premium to the dollar. An increase in the dividend by the UK company will be that much more profitable because the dividend payment has to be converted into dollars. This is not just true for stock investments, but also for euro bond investments as well. Easy accessibility of quality international companies. The most obvious benefit of ADRs is that they make international companies more accessible. If you want to buy 100 shares of Teva Pharmaceuticals, the generic pharmaceutical giant, all you need to do is call your broker or log on to your online account. There is no need to physically transfer funds to a distant land to purchase the stock. Now let's look at some of the drawbacks in ADR investing. Of course, your ADR investments are subject to some of the same risks as your domestic investments, including credit, currency, or inflation risk. These should be taken into account regardless of the state of the market, which is the home country for the foreign company. Local currencies of some markets, such as Australia and Canada, react sharply to movements in commodities. A huge hike in the gold or oil prices will appreciate their currencies, and on the contrary, a drop in commodity prices would depreciate their local currencies. Investors should be able to stomach such gyrations, which will have a direct impact on their investments. Now, not all ADRs are safe to invest. There are 3 levels of ADRs on the US markets. Level 1 ADRs are highly speculative and have a thin market since they are traded over the counter. But interestingly, Level 1 ADR issues are the fastest growing segment of the market, according to the Bank of New York Mellon. Companies whose shares are traded in Level 1 do not require to adhere to such stringent reporting rules. Level 2 and Level 3 ADRs are traded on the NASDAQ or NYSE, and these companies have to follow the US GAAP rules for reporting and the SEC regulations similar to their counterpart US companies. So it is safest for investors to invest or trade Level 2 or Level 3 ADRs. A word about the tax treatment on the ADRs. Except for the fact that investors may claim back the tax withheld as per the tax laws of many countries, ADRs have similar tax treatments by the IRS as domestic stocks. Apart from ADR investing, another very safe method of investing internationally is to invest in US multinationals. Several top US companies derive bulk of their revenue from international sources. Buying shares of US multinationals such as GE, McDonald's, Coca-Cola, etc. can be an effective way for investors to get exposure to the global economy. Finally, one cannot ignore the option of investing internationally by trading directly through international trading desks of brokerages. Many brokerage firms offer this option at a premium price for investors. These trades are not only more expensive but also less liquid than domestic trades. Unless you have carefully analyzed all the pros and cons of using this method, you must not venture into this. You must resort to the other methods I discussed with you earlier in this episode, which are much safer for the common investor. Coming up next is emerging markets. Are they right for you, and how much, and how to add them in your portfolio? Stay tuned. Invest Wisely will be shortly back after the break. Don't go away.